So I'm going to ask you to hold your questions for a little bit because we have Andrew who's been waiting so patiently. Thank you, Andrew. I would love to spend time introducing Andrew. I'm just going to tell you quickly that Andrew Morris is from NAFCU. I think most people here today are here to hear him, and everyone on live stream, I know I got a lot of positive response on that. You're having NAFCU come. We have lots of questions. So, Andrew, you're going to have a lot of questions later today at the panel. Andrew is a graduate of the George Washington University Law School. Andrew works in NAFCU's Research and Regulatory Affairs Division. I guess you can read more about Andrew in the notebook. I don't want to take any more time. Andrew, we will give you your full hour, so feel free to talk. And if it's going above anybody's heads, come talk to me.
Where is the clicker is the question. All right.
Okay, why don't we try it?
Oh, yeah, perfect. Okay. Just get myself set up here.
Well, let me know, Andrew, if it doesn't work at any point. I'm sitting in the back. Be happy to.
Great. All right. Good morning, everyone. My name is Andrew Morris, Senior Counsel for Research and Policy at NAFCU. Glad to have you all here. I'm going to give you a very whirlwind tour of regulations that touch digital assets. I think that's by necessity because there's a lot of complexity in this space, and it would take just far too long to really do a deep dive into any particular area because a lot of the regulations are in flux, and to really understand their application, you kind of have to read between the lines and really get into the nuance of definitions and interpretation and even case law in some cases to understand how this puzzle fits together. But before I get any further, I do want to provide a legal disclaimer. I've put it up here, but anything I say today, anything in this presentation shouldn't be construed as legal advice, shouldn't be construed as investment advice, and nothing that I say today should be construed as an offer, recommendation, or solicitation for a financial product or an investment. Great, so that's out of the way. The agenda is a little mangled here, but maybe one thing I'll ask is how many people in the room are compliance officers or risk officers at their credit union? All right. Okay, so that helps me kind of dial in the presentation a little bit. I'll try to keep things as general as possible. I start out talking about digital asset taxonomy, which is a fancy name for how do we classify these things, and why does this matter for regulatory purposes? It matters for regulatory purposes in many respects, and we'll start with cryptocurrencies. Or actually, first we'll just talk about some of the regulator perspectives on digital assets in general. You'll find, again, I think this might be cut off slightly, but you'll find in your workbook that there are some quotes from different regulators like the SEC or the CFTC, FinCEN, the NCUA, where they're grappling with this concept of what are digital assets. And you'll notice in their definitions that they tend to emphasize in their definitions the things or qualities about digital assets that are most relevant to their jurisdictional nexus, right? So FinCEN, for example, is concerned about administrating rules concerning anti-money laundering, the Bank Secrecy Act. They're there to prevent financial crime. So in keeping with their sort of regulatory framework, their definition emphasizes the currency aspect of digital assets, and they talk about value that substitutes for currency. The word they use in their regulations for referring to digital assets, generally speaking, is convertible virtual currency, CVC, something that you won't see, for example, in the SEC commentary or SEC guidance around digital assets, which talks about things like virtual currencies or tokens or coins, but you won't see convertible virtual currency referenced specifically. So that's where you start to see some divergence between regulatory terminology and classification that could be relevant to your own understanding. Cryptocurrencies, we talked about that earlier. I won't belabor this subject, but one thing I do want to flag is that the technological underpinning of a cryptocurrency can matter for regulatory purposes. So for example, if you're dealing with something that has a public ledger, right, where you can see the transactions, that makes the auditability of those transactions comparatively easier, could influence how you comply with Bank Secrecy Act or anti-money laundering regulations or how a third party does. That's going to be something that leverages chain analytics, blockchain analytics firms to understand what is happening and how transactions are occurring. But if you're dealing with a ledger that is truly anonymous and that obfuscates the ledger's transaction history, something like a coin like Monero, then you might be in a different regulatory framework. So, for example, FinCEN has talked about anonymity enhanced cryptocurrencies, or AECs, and they have noted that these AECs have a known connection with illicit finance activities, and they actually cite a couple of cryptocurrencies. I believe Monero is among them. So again, you want to be aware of what kind of cryptocurrency you're dealing with, what kind of anonymity preserving features are inherent to that technology in order to understand how a regulator like FinCEN might approach the use or the offering of that type of asset. Cryptocurrencies regarded as commodities by the CFTC. I have a quote here from an enforcement action that they brought. I won't read it. But also cryptocurrencies can be classified as securities. So this kind of illustrates a tension between different regulators, the SEC, Securities Exchange Commission, and the CFTC, over who is going to take the lead in this space. We have tokens. I think tokens can be somewhat confusing because they're often inconsistently defined. Sometimes they can reflect things that don't necessarily have a monetary function. They could just be a smart contract. Other times they could be NFTs. The SEC has described in guidance this concept of a utility token. Not really elaborating on it too much, and I would say it's actually been referenced mainly in speeches by representatives of the SEC, but it highlights this notion that some tokens, because they have a utility function, might not be regarded as securities. But the key point to understand is that the SEC has said, for example, that something like a token, just because it calls itself a utility token, isn't necessarily dispositive of whether it would be a security, for example. And we'll talk about why that matters under SEC rules. But as we can see, there's a case here about tokens being offered where the SEC found that the manner in which they were offered suggested that they were securities, and that the offering was in fact a offering of unregistered securities, which isn't allowed under SEC rules. This case, Tomahawk Exploration. I won't go into the details of this case. Again, there's a lot to cover here, but I'm including it just so that you're aware of some of the, commentary, case law, et cetera, that speaks to how these things might be regulated. Stablecoins. Stablecoins get a lot of attention. These are digital assets that are meant to have a stable value. They're usually pegged to some sort of fiat currency, like the US dollar, for example. Often have the same technical characteristics as cryptocurrencies. And I would say the document that is most important in this domain, that kind of provides some vision for what future regulation might look like, is this thing called the President's Working Group Report on Stablecoins. And this document contains the recommendations of a group of banking regulators. NCUA was not included, but this group of banking regulators, Treasury, FDIC, the OCC, had specific things to say about who should be issuing stablecoins, and they say that issuance should be limited to insured depository institutions. They have things to say about the requirements that might apply to stablecoin custodians, custodial providers who are hosting or safekeeping wallets, and they talk about separation of banking and commerce. So the document is quite long, lays out a fairly comprehensive discussion of the different prudential, so safety and soundness standards that might apply in this space, as well as consumer and investor protection issues. And then we have central bank digital currency. Central bank digital currency is, I think, pretty unique. We don't have it yet in the United States, but it's under discussion. And this would be something that the Federal Reserve provides. Central bank digital currency would be a liability of the central bank, the Federal Reserve. It would be different from commercial bank money, which are balances held at banks, credit unions. And it would be different, obviously, than non-bank money, which is a cryptocurrency, something that exists outside of the traditional banking or credit union system. There's discussion around how you might offer this. The idea of a CBDC is to offer the public access to central bank money, but how do you do it? Do you do it directly? Do you do it indirectly, leveraging the existing infrastructure of financial institutions like credit unions? And that leads to a discussion in various papers published by central bank authorities and the Federal Reserve about what model of issuance to use. And I won't get into too much detail, but I just want you to be aware that central bank digital currency could be very disruptive to credit unions. The reason why is because depending on how it's structured, if it's offered directly to the public, you are now competing with the Federal Reserve for safe, I guess, deposits, because somebody might choose to put their money in a central bank digital currency account that exists directly with the Federal Reserve instead of depositing that money as commercial bank money into a financial institution or credit union. And that could, change all sorts of things with respect to financial stability, how you lend. So it has big implications, as does, its status as legal tender. Is it lawfully able to be used to pay a debt? And there are regulatory implications for how you, I guess, design the transaction architecture for this thing. Is it safe? Is it secure? What degree of privacy does it afford to people? And how does that impact BSA AML compliance? All these are open-ended questions. NAFCU has written comments, as have other trade associations. We'll get to this later in the presentation, but just want to put CBDC out there as one form of digital assets among many others. So now we'll talk about different regulatory frameworks, the regulators that are involved. And I think for this part of the discussion, I won't try to get into too much detail about the individual regulations. I think that would be too much. Again, it would require more time than we have today to really dive deep into the individual regulations that we're going to talk about. But I do kind of want to give you a sense of how deep the ocean is, so to speak, in this space. There are a lot of competing regulatory frameworks. There's a lot of uncertainty, and in most cases, you're just going to be left with questions and not many answers. And that's just the reality of dealing with digital assets today in an environment where regulations are in flux, where there's a lot of legislative interest. You have recommendations like that stablecoin report I talked about, and then later we'll talk about an executive order that basically is like a whole of government approach to answering some of the fundamental questions that relate to how to regulate digital assets. And some of those fundamental questions are listed here, like how do you comply with anti-money laundering rules? How do you deal with safekeeping, so custody? How do you protect investors and manage capital markets? That would be the domain of the SEC or the CFTC. What about payment system risk? That's something where the Federal Reserve might have something to say as the operator of access to the payment system. And then, of course, consumer protection is something the CFPB might be interested in. So all these different strands of regulatory thought are feeding into an environment where, again, there are a lot of questions and not too many concrete answers. So first I'll talk about the SEC and the CFTC. To put things in perspective, because digital assets could be regarded as securities, we want to think about what rules would apply if something is considered a security. If something is a security, it's going to be subject to SEC rules. And generally speaking, if something is a security, it's going to need to be registered as a security with the SEC, or it's going to need to qualify for some sort of exemption. We'll talk about how that impacts the way credit unions interact with digital assets in the next slide. But for now, I just want to point out that on this particular slide, there are some quotes, pieces of guidance here that are meant to illustrate that many different types of digital assets might be regarded as a security. I don't think there's any type of digital asset that is immune just by its very nature from being considered a security. It's a facts and circumstances test. And the test that the SEC relies upon is something called investment contract analysis, which draws from a seminal Supreme Court case, SEC v. Howey, which talks about whether something is an investment contract. An investment contract is a security, and there is an investment contract if there is an investment of money and a common enterprise with a reasonable expectation of profit derived from the efforts of others. Those are the magic words that are in Howey. And SEC guidance published in 2019 kind of atomized each of those statements to explain how you apply this investment contract analysis to digital assets in particular. The CFTC is another regulator, and the CFTC has claimed that Bitcoin and other virtual assets are commodities. So naturally it leads to this question: are we dealing with a security? Are we dealing with a commodity? It's sort of unclear. I think both agencies have tried to cooperate with each other in the way they bring enforcement actions. But the CFTC, their jurisdiction lies in derivatives markets. So they're concerned with swaps, futures, options. You see CFTC enforcement actions involving digital assets primarily invoking their general anti-fraud, anti-manipulation authority. So they've They've fined exchanges for failing to disclose certain information. But generally speaking, the CFTC is not going to be exercising registration jurisdiction the same way the SEC would if something were, say, classified as a security. The other thing is the CFTC has issued guidance recently talking about the potential hazards of offering leverage or financing in connection with a spot market. Again, this isn't going to really concern anyone that is not an exchange, but it could be relevant if you are trying to assess the overall compliance posture of a third party that does happen to be an exchange that you're dealing with. So why does security law really matter for credit unions? Well, as I said before, securities have to be registered or they have to qualify for an exemption. And if you're offering securities, so non-deposit investments, for example, to members, you need to be aware that doing so is going to require you to go through a broker. A broker is anyone engaged in the business of affecting transactions and securities for the accounts of others. The NCUA has written a letter to credit unions regarding sales of non-deposit investments. This letter is addressed to federal credit unions. And in this letter, the NCUA acknowledges some structural limitations that federal credit unions face in terms of registering as a broker-dealer. And they're essentially saying, you need to do this in a way that doesn't make you a broker. And they give you some options. They're listed on the last 3 bullets of this slide. One way to structure it is to own a CUSO that's a broker that sells non-deposit investments. You could have a shared employee arrangement with a third-party brokerage. The federal credit union could act as a finder. And the NCUA has spoken in greater depth about finder activities in the space in a letter to credit unions. We'll get to that later. But I just want to kind of lay this all out because the reason we care about securities law treatment is because credit unions need to be careful about how they structure the relationships with third parties when they are allowing members to engage with digital assets. So now we can get to the NCUA. The NCUA has released 2 letters to credit unions, which I think are pretty specific to digital asset issues. The first is a letter to credit union concerning relationships with third parties. That kind of speaks to the finder activity I was talking about earlier. The other one is about distributed ledger technology. We'll talk more about those. One new thing is that the NCUA released its spring rulemaking agenda for this year, and one item that's listed is a potential rulemaking slated for December this year on some digital asset issue. I don't know what it might be. And I would also say that it appears to be contingent on how the NCUA evaluates comments that it received in response to a request for information it issued last year on the topic of digital assets. So it reflects the NCUA's sort of ongoing process of evaluating what digital asset activities are credit unions interested in, and where might it be helpful to engage in rulemaking. Some NCUA regulations are going to be relevant to digital asset activities, and these are referenced in that first letter to credit unions. One is Part 740, which is the NCUA regulation that prohibits deceptive or misleading advertisements. So this would concern representations about the insured status of a digital asset, for example. There's also Part 721, which talks about finder activity under a list of incidental powers. And then Part 748, which concerns BSA compliance, IT security, member information safeguards, all things that could be potentially relevant in the space of engaging with digital assets. So let's talk a little bit about the letter to credit unions involving third parties that provide these services. I would say that the letter is really focused on third-party vendor relationships. A lot of the letter is focused on what kind of due diligence you would do as a credit union. I bolded a few things that I think are important. In your contractual agreements, the NCUA is saying that you should cover indemnification, so you should require in your contracts indemnification provisions for any monetary damages arising from the provision of digital assets, including fraud. You want to ensure ongoing compliance with all requirements of applicable law. That's on you as the credit union to understand, depending on what activity you're engaged in. So it could potentially be a lot of different laws. The NCUA isn't necessarily going, and enumerating every single possible use case or activity. They're writing the letter in very broad terms to emphasize that, you need to have strong risk assessment, due diligence processes in order to understand all the legal risks that might, be involved in the particular activity you're engaged with, or I should say the third party is engaged with. There are some considerations around advertising. I've listed those on the right-hand column. You know, NCUA is suggesting that some of these statements should be included to avoid misleading members. I won't go into all of it, but you know, I'm putting it out there to show that there is some thinking by the NCUA around how you would go about informing members about what they're actually dealing with. And of course, in the letter, there's recognition of sort of those major buckets of regulatory concerns that we talked about at the beginning: cybersecurity, consumer protection, BSA, AML compliance to prevent financial crime, et cetera. A big part of credit union compliance in general is Part 748 compliance, and this is the regulation that covers the credit union's written security program, its filing of reports as required under the Bank Secrecy Act, under FinCEN regulations. It concerns member information safeguards. I include this because I think it's responsive to some of the security risks that could arise if you are engaged in digital asset activities, as well as sort of the AML concerns. It also is relevant to the extent that Part 748, specifically Appendix A, and I think Appendix A, Section D is what it should say, addresses how you go about undertaking sort of the due diligence when selecting service providers. There's also an NCUA supervisory letter that talks about evaluating third-party relationships. I have some quotes there that I think are relevant, and I think which are reflected in the letters to credit unions, or in the letter to credit union that we just discussed about third-party relationships to facilitate engagement with digital assets. Again, the same emphasis on due diligence, appropriate risk assessment, and ensuring that you are in compliance with all applicable law and regulation are all kind of consistent themes that we see in Part 748 as well as those letters. The other letter that's specific to digital asset activity is one concerning use of distributed ledger technology. So the top line, message there is that distributed ledger used as an underlying technology is not prohibited if it is deployed for permissible activities and in compliance with all applicable rules and regulations. Again, putting a lot of the burden on credit unions to understand exactly what rules and regulations are going to be applicable. And this letter isn't, again, enumerating a list of use cases. It's really taking a much more open-ended, broad-minded view of, how to go about performing due diligence, risk assessments, and governance and oversight with respect to this particular form of technology. So you see on the left-hand column, the emphasis on effective risk management practices, on informing the board of directors about what this technology represents, how it accomplishes the objectives of the credit union. And then there are some things that are kind of unique to DLT that are referenced in this letter. And again, these are considerations that might be specific to certain use cases, not all use cases. But something like, for example, asking the question, are each of the nodes in a distributed ledger environment BSA compliant, meaning are they in compliance with anti-money laundering rules administered by FinCEN? Is there an understanding of how the consensus mechanism works in a DLT environment? These are questions that might be more difficult to answer because they really are kind of on the forefront of technological understanding, and it might require some work to educate your management or your board about how these things work exactly. And certainly there are a bunch of areas where you just need more guidance before you can have any real understanding of whether you can engage in these activities. The NCUA hasn't spoken about custodial activity, whether you can hold digital assets directly and safekeep them for members. Compare that with the guidance provided to national banks. The OCC issued an interpretive letter about the authority of national banks to provide cryptocurrency custody services. So national banks, comparatively speaking, benefiting from a little more guidance in this space. Same with the concept of issuance. No commentary from the NCUA there. Likely would require legislative, regulatory changes to really get to whether or not that's a permissible activity. But the OCC, Office of the Comptroller of the Currency, has provided banks with interpretive letters, or an interpretive letter, I should say, saying that national banks can issue stablecoins to facilitate payments or operation of what they call independent node verification networks, which are essentially a fancy name for a distributed ledger. So, national banks are benefiting from, I would say, comparatively more guidance, more specific guidance in this space. I think the letters to credit unions that we talked about previously are much more open-ended and I would say less use case specific. And then lastly, governance activity. What about activities that might not have any real connection to, let's say, the monetary functions of digital assets, voting, something like that? Again, no commentary or opinion there on whether that is a permissible use. I think you have to work through the considerations in the NCUA's guidance, open-ended as they are, to really understand whether this is something that is permissible. Something certainly you'd want to involve counsel with and probably have a discussion with NCUA about. And of course, if the NCUA is thinking about authorizing new activities or recognizing new activities as permissible, for federal credit unions at least, the analysis it might undertake could involve incidental powers analysis. This relies on a section of the Federal Credit Union Act which provides that federal credit unions can exercise incidental powers as shall be necessary or requisite to enable it to carry on effectively the business for which it is incorporated, which is a fancy way of saying you can engage in activities that aren't specifically enumerated here if they are incidental. And there's a test the NCUA uses for determining incidental powers. Part 721 of the NCUA's regulations lists different types of incidental powers. Acting as a finder is one of them. I won't go into sort of depth as to the test, but you'll see in the last 3 bullets that those are the considerations, or characteristics, I should say, of a activity that would meet the test for being incidental, an incidental power. And there's case law that supports this, case law that is actually used by the banking regulators as well to interpret their incidental powers authority. And the NCUA has written letters to credit unions describing how it applies this analysis. And I flag this because it could potentially be relevant if you are thinking about whether something is an incidental power or not, or providing comments to the agency about what should be recognized as an incidental power. So being aware of this kind of framework of incidental powers analysis might be helpful if you are providing comments to the agency in the future about what type of digital asset activities you might be thinking about engaging in. So now we'll turn to a group of regulators that are tasked with administering laws designed to prevent financial crime, combat terrorist financing. That's Treasury, FinCEN, the Financial Crimes Enforcement Network, and OFAC, the Office of Foreign Assets Control. Generally, FinCEN administers the Bank Secrecy Act. Their regulations require credit unions to establish anti-money laundering programs. FinCEN, for a number of years, has, in its own interpretations and regulations, indicated that what they call convertible virtual currencies are encompassed within its anti-money laundering rules. And the Anti-Money Laundering Act of 2020, which passed at the very beginning of 2021, it was enacted, actually amended the definition of a monetary instrument in the Bank Secrecy Act to, again, crystallize that understanding that monetary instruments include things like convertible virtual currency, the magic word being value that substitutes for currency, or I should say the magic phrase. And in so doing, this act has sort of made it clear that FinCEN and its regulations apply to transactions involving things that are virtual currencies. And you have to have appropriate AML procedures, customer identification procedures, when you are engaging with digital asset technology. We'll talk a little bit about OFAC. OFAC actually, in 2018, began including known virtual currency addresses in its list of blocked individuals or entities. OFAC is an office within Treasury. Credit unions under OFAC rules have to block transactions involving sanctioned entities. Treasury, through OFAC, has actually sanctioned at least one exchange, so you should be aware that exchanges could be potential targets of sanctions if they're engaged in illicit financial activity. OFAC's published guidance also for companies handling virtual currencies. I would say, This is probably mostly going to be applicable to exchanges, but again, it really depends on what level of involvement you have in terms of actually facilitating transactions in digital currency. So want to make you aware that OFAC controls are going to be relevant in this space, as are the traditional bundle of FinCEN regulations that credit unions are already, credit unions are already familiar with OFAC rules. They should also be familiar with FinCEN's rules, things like customer due diligence, the travel and record keeping rule, currency transaction reports, suspicious activity reports. The travel rule and the record keeping rule are essentially designed to ensure that there is reporting of information about transactions in amounts of $3,000 or more that is transmitted in the chain of transactions. The FinCEN has proposed amending this rule in different ways. One is to clarify again that it's applicable to convertible virtual currencies. They also wanted to lower the threshold for reporting certain transactions that begin or end outside of the United States. A separate proposal issued in December 2020 addressed how financial institutions would report activity involving unhosted wallets or covered wallets, which might be located in a country that is a covered country, for example, because it is flagged as having illicit financial activity or a nexus with illicit financial activity. And this would also encompass things like digital assets with legal tender status. So that could be something like a foreign central bank digital currency. Again, these are just proposals. They haven't been finalized yet, but I flagged them here because they could be relevant ultimately to the new standards for reporting suspicious activity or currency transaction reports. Currency transaction reports are essentially similar to what's stated here, reports of transactions in currency aggregating $10,000 or more in a single day. And of course, suspicious activity reports, there are specific rules there. I won't get into too much of this, but I want you to be aware the suspicious activity reports also encompass activities that might involve digital currency. Some of the red flags listed on the right hand, or it's not in a column here, but in your booklet it should appear as a column. Some of the things that might be regarded as suspicious activity could be specific to digital assets, like a common wallet address being shared between accounts. Again, this is likely going to be most applicable to a third party if it's charged with or ensuring compliance with these rules and is actually handling the wallets. But I frame this generally as just digital asset activity because looking forward in the future, depending on what activities credit unions are engaged with in this space, you should be aware that FinCEN has published guidance related to how you would identify suspicious activity that is unique to the digital assets ecosystem. And of course, there's more activity on the horizon. As I said, those proposed rules on the last slide, not final yet. There is guidance that does describe the distinction between hosted wallets and unhosted wallets. Hosted wallets are basically wallets that a intermediary has access to and conducts transactions on behalf of a customer as a money transmitter. An unhosted wallet would be something where the user has control of their digital currency or their digital assets. And no intermediary is necessary for them to effectuate transactions with an unhosted wallet. And that obviously raises concerns around being able to monitor transactions for the purpose of preventing money laundering, because if the end user of an unhosted wallet has full control over its transaction capabilities, then they could be sending digital assets, virtual currency, to criminals for money laundering purposes, could be sending it to sanctioned persons or entities. So FinCEN has been thinking about a proposal that would require financial institutions to record information, in some cases report significant cryptocurrency transactions involving unhosted wallets. FinCEN's also recognized in its anti-money laundering and countering financing of terrorism national priorities document that future rulemaking might be necessary, acknowledging kind of the challenges associated with combating illicit finance that involves convertible virtual currency. Also, there might be other tools besides just rulemaking. The President's Working Group report on stablecoins acknowledges that Treasury and FinCEN might pursue other avenues, potentially leveraging additional supervisory tools to combat illicit finance that leverages stablecoins, potentially other digital assets. So now we turn to the Consumer Financial Protection Bureau. The CFPB has not said a lot about how its regulations interact with digital assets. Director Chopra has made some statements and press releases about the application of consumer financial law to digital assets and how it might depend on the activity in question, but nothing specific. Saying something like these use cases and others trigger obligations under federal consumer financial protection laws, including the prohibition on unfair, deceptive, or abusive acts or practices, I think is a very broad statement. You're not benefiting from clarity with respect to how individual regulations like Regulation E, which applies to electronic funds transfers, how that might apply. I'll say that when you're talking about something like retail and consumer payment systems, to the extent Reg E is involved, you have to be aware of what the definition of electronic fund transfer is. Generally, these are transfers that involve funds initiated through point-of-sale systems, ATMs, direct deposit, telephone transfers, debit cards, not necessarily an exclusive list, but be aware that there's also an exclusion in that definition for securities and commodity transfers. And one of the kind of tricky aspects there is understanding that sort of narrow exception in Regulation E for securities and commodities transactions is going to be limited to transactions involving broker-dealers. So again, I'm not going to try to synthesize all of this law in 15 minutes or however much time I have remaining, but I want to just throw this all out there because it illustrates that there are a lot of different ways that consumer financial law can be applied to a particular use case. So, I gave the example of consumer retail payment, but if you're talking about stored value instruments, like what happens if you have something that's like a prepaid account that is loaded up with value that is from a cryptocurrency? How do the CFPB's rules apply in that space? Again, these questions aren't clearly answered by the CFPB. I will say, though, that if you are touching traditional financial activities, like say you are providing loans to finance the acquisition of digital assets, to the extent that those credit arrangements involve fiat currency, you're going to be in the world of the CFPB's regulations as they exist today, like Regulation Z, which implements the Truth in Lending Act, or Regulation B, which implements the Equal Credit Opportunity Act. You can't discriminate in those credit transactions. You can't have deceptive statements when advertising the rates that are applicable to those credit transactions. Again, it depends on the activity, and it really requires an understanding of what portion of the activity is going to trigger CFPB regulations by virtue of the fact that let's say it's again like a lending transaction to acquire digital assets. If that's in fiat currency, you're going to be in the world of the CFPB's Reg Z, Reg B credit rules. But if you're now talking about transactions that are purely in the domain of virtual currencies, I think there are more questions to be answered, and the CFPB has so far not really articulated much than this sort of general warning, don't engage in unfair, deceptive, or abusive acts or practices. And UDAP itself is a kind of evolving body of regulatory expectations, because the CFPB traditionally has advanced its interpretation of what abusive acts or practices are through enforcement actions. So it's not like you can rely necessarily upon a codified regulation saying these things are abusive or these things are deceptive. You have to look at case law, enforcement actions, and commentary that the CFPB has provided to really understand what their expectations might be in the space. And of course, the CFPB, or at least Director Chopra, has commented about misrepresenting, the insurance status of digital assets, something I think the NCOA is also concerned about. So, if anything, that should be top of mind. Don't mistakenly imply that digital assets are insured if they're not. Federal Reserve, this is the regulator that would be primarily involved in future discussion around central bank digital currency. As I mentioned before, central bank digital currency is something that could be pretty disruptive, and I think the Federal Reserve, at least fortunately, recognizes that and has proposed in a consultative paper a method for potentially offering central bank digital currency by leveraging the infrastructure of existing financial institutions. So this would be a form where credit unions, banks would provide CBDC accounts to consumers rather than the Federal Reserve providing it directly, at least as envisioned in this Federal Reserve paper that they issued in January. And I'll say that I think the Federal Reserve at this stage is not committed to any particular policy outcome. They're very much in a consultative mode, which I think is a good thing. But as we'll see when we talk about the executive order, other agencies have been introduced into this space, and they are also considering policy issues around whether or not it would be desirable to introduce a central bank digital currency. So the Federal Reserve, although it has taken the lead apparently, won't be the only agency involved in this space, but I think they have done the most to articulate parameters for how a central bank digital currency might be offered. So for example, things like, would it be desirable to have limits on end user central bank digital currency balances so that they don't compete with retail deposits at credit unions? Because again, central bank digital currency as a liability of the central bank would be probably the safest asset you could possibly hold. And of course, there are federal deposit insurance limits applicable to banks. Then CUSIP has an insurance limit, $250,000. So, would it make sense, for example, to have limits on the amount of CBDC that an end user could hold so that there isn't competition for retail deposits, which could, of course, disrupt the funding that banks or credit unions have access to. Federal Reserve is also responsible for managing the rules associated with payment system access. I don't think this is particularly relevant to credit unions per se, but does have an impact on the overall competitive state of the financial sector, and especially the financial stability risks that might be injected if, for example, you have certain entities heavily engaged in digital asset activities participating in the payment space. Kind of talking about stable coins, for example, these are coins that are meant to have stable value, right? But there has been concern around what the quality of the stable coin really is if there's uncertainty regarding, for example, the reserves that are backing the stablecoin, or algorithmically how the stablecoin maintains its peg to the dollar or some other fiat currency. And the Federal Reserve, I think, is concerned, or interested, I should say, in adopting uniform and transparent guidelines for payment system and service access, so meaning essentially the standards that applies when evaluating requests from financial institutions that are seeking master account access, so that these risks, if they are present or potentially present in an applicant's business model, are sufficiently evaluated and understood. So that's kind of just a very brief overview of how the Federal Reserve might operate in this space. Lastly, I'll talk about this executive order on digital assets. On March 9th this year, White House published an executive order ensuring responsible development of digital assets. It targets a very, very, very broad list of policy concerns and priorities. So obviously, consumer, investor protection, protections for businesses that might be using digital assets, financial stability concerns, financial crime concerns that could extend to national security, and even things like climate change and pollution. I won't necessarily pretend to understand what the full scope of that discussion might look like, but certainly there's been attention in the news about the sort of energy demands associated with mining certain cryptocurrencies. So that's thrown in there as well. So it's a very broad whole of government approach to addressing digital asset issues. And I think the important thing to know about this executive order is that because all these different agencies across government, Department of Treasury, the federal banking agencies, the Department of Commerce, among many others, the Financial Stability Oversight Council, the Federal Reserve, because they're all working on addressing these issues posed in the executive order, there could be a lot of regulatory change in the future as they consider these questions and produce reports, the majority of which are due 180 days from the date the executive order was published. So we could see them publicly by the end of this year. I would say that right now it's unclear how far along in development they are, but we've already seen certain agencies that aren't traditionally involved in the space of financial regulation issuing requests for comment on some of the issues contained in this executive order. So for example, the Department of Commerce has recently issued a request for information about how digital assets might affect American competitiveness, but also considering issues that are relevant to the credit union system and the financial sector as a whole, such as whether or not it would, again, be suitable to introduce a central bank digital currency, what effect that would have on financial stability, and how it would either enhance or change the status of American competitiveness. So we have to wait to see what these reports will say to really have a firm understanding of what the regulatory landscape might look like in the future. But I think this all points towards just how much of the regulatory space is in flux right now, and how much uncertainty there is about what future frameworks might pop up to address things like the risk that digital assets might pose in specific domains, such as payments or financial crime. And lastly, on this slide, I've selected a few different proposed pieces of legislation to just illustrate how there are different approaches and priorities for regulating digital assets. These are just proposals. I can't say where they're going in the future, but I do think they're interesting insofar as they illustrate how some concerns overshadow others potentially. You have one bill that wants to classify stablecoins as securities. Contrast that with, for example, the Loomis-Gillibrand Responsible Innovation Act, where there's a desire to provide clarity that some things are securities, some things are commodities, but generally preferring, I think, the CFTC as the lead regulator in this space. There's the Stablecoin Transparency Act, which again is kind of playing up the securities angle. The Clarity for Digital Tokens Act, which is trying to kind of develop a sandbox environment, I would say, for testing tokens without kind of the regulatory overlay of securities registration. And then you have something even addressing central bank digital currency, this untitled bill that was introduced to amend the Federal Reserve Act to prohibit the reserve banks from offering certain products or services directly to an individual. I think this is in response to proposals to have the Federal Reserve offer central bank digital currency directly to the public. So obviously, there's a range of different considerations present in all these bills, different approaches, different frameworks, but nothing that seems to be a complete synthesis of every issue that could possibly arise, which I think just speaks to the challenge that exists before the regulators, named in the executive order, and how many different types of federal agencies are likely going to be involved in terms of synthesizing all of the different concerns and priorities, consumer protection, investor protection, capital markets operation, financial crime, synthesizing all of that into something that is coherent, but is still accommodating of innovation in the financial sector. So that's the end. That was really quick, I know, and a lot, but I wanted to leave some time for questions if there are any. Go ahead. How it's going to infiltrate every aspect of our life. I'm not sure if it will. I think that's my first take, just me speaking personally. But as far as coexisting with the existing payment systems and existing ways we conduct transactions, I think already you see adoption of blockchain technology and things like games, for example, where there's the ability to, for example, sell NFTs or things that have value, where I think before there wasn't anything quite like that type of marketplace. I don't know if that will rise to the level of infiltrating your life, so to speak, but as with all technology, it's difficult to predict how ubiquitous it will ultimately become. Back when cards were introduced as a way for initiating payments, there was, I think, a similar amount of perhaps regulatory uncertainty then as there might be today. And certainly back then, and even today, there is no such thing really as a card rule, in the sense that you can just go somewhere and see every single regulatory requirement that is applicable to a card as a technology in one place. You have to go to different regulations and apply different regulations to the technology to understand what rules are applicable. And it's a process of shifting gears and lanes, so to speak, in order to really map out regulatory requirements. And there is no, I guess, single source or document that you can go to just understand everything.
Any more questions? And we just have a request from the live streamers. If you're asking a question, just wait till we bring you the microphone. And then, Andrew, if you could repeat the question so we make sure everybody got it. So
Sure.
I'm sure we have more questions. No? If not, Andrew, I'll just ask you if you can sum up everything you said in 2 sentences or less.
It looks like there's a question to save me, right?
Wait, I'm sorry.
Hi, this is Henry Ryan for the New York Credit Union Association. You do great work, by the way. And
Thank you.
I'm a big fan from a distance. One of the questions I have is, what is your sense as to the approach that NCUA has taken? On the one hand, they have come out with the letters, the guidance letters that you have talked about. But on the other hand, it seems as if they want to get the conversation started, but aren't quite sure where they want it to end. So where does that leave? If you were giving advice to credit unions right now as to where they would go in the space and how they would get started, what advice would you give? I know what I would say, but I'm curious what you would say.
Sure. So I think the most helpful thing for NCUA, especially where they're at, is to really be able to describe clearly what your credit union wants to do, because that helps them clarify their thinking and focus on, whether or not regulatory changes need to be made in response to that specific activity that you're proposing. If you come to NCUA with a very open-ended request, or even just a question along the lines of what can I do with digital assets without giving any sort of examples, I think it's going to be challenging for the agency to anticipate exactly what is deserving of their administrative resources and rulemaking attention. So to the extent that a specific concrete example of what you want to do with digital assets can be provided, I think that can help steer the discussion in a positive way that hopefully is able to provide the clarity that you would be looking for as a credit union in the space. Does that answer your question?
Do we have any more questions, or are we going to ask Andrew to summarize everything? Okay, well, I will tell you you'll have another opportunity to ask questions when we do the panel at 4 o'clock this afternoon. So, Andrew, thank you very much. This was super informative.